Home loan arrears are untouched by COVID or the lockdowns. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. We're going to have a look at this article from Mortgage Business because it's discussing a Standards & Poor report looking at debt serviceability here in Australia. And well, lockdowns, first recession in 28 years, global pandemic have not had an impact on housing loan arrears here in Australia. Now, obviously, this is not going to count the houses or the people that were on mortgage holiday or mortgage keeper pretty much because, well, they were at no risk of foreclosure. Really, no one was at any risk of foreclosure, at least from the CommBank, until September this year. So I'll have to confirm what date that is, if it's the end of the month. When that kicks over, do you think we'll see a flood of bank foreclosed properties? I seriously doubt it. The pandemic and ongoing lockdowns have had little effect on debt serviceability in Australia so far, according to a new report. And let's bring up some charts to show you a few things. This is showing you home loans in negative equity. It's barely at over 1%. So it's gone down from the peak in 2019, over 3%. There you go. You've got housing loan prepayments. People are paying ahead, which I encourage, which is good to see. And, well, it takes the stress off a bit. And you've got liquidity buffers. Indebted homeowners, renters, and outright homeowners have months of money set aside. Now, here's something we need to consider. If you are suffering from housing stress, one thing that, well, the definition of that is it's when a low-income household spends more than 30% of their gross income on housing costs. And this is because, well, for someone on a good wicket, and I'll show you what a good wicket is, guys, if you don't remember, over $2,000 a week for a household, where the lowest is $433 a week. That's a big difference. That chart right there is the class divide in Australia. This is why some people are not feeling the lockdowns. They're not even noticing the economic impact, while others are just breezing along like there's no problem. Now, if you're earning $2,000 a week, and sure, a third of it's going, $700 is going to your housing costs, but you have some issues, disruption, a change, you've probably got more ability to deal with it than someone who's on $433 a week and is spending a third of their income just on housing. What's a sharp increase in your grocery bill going to do to someone on $433 compared to someone on $2,000? You've got more room to wiggle. But still, we still haven't seen arrears shoot up. 3 months after the formal expiration of the first round of mortgage deferrals brought on by COVID, S&P Global Ratings has reported the results are better than expected. As outlined in S&P RMB's Performance Watch Australia report, Standard & Poor's Performance Index for Aussie prime mortgages fell to 0.9% in June from 1.15% a year prior. A number of banks in the current reporting season have conveyed that the current level of mortgage deferrals are not significant and are much lower than they were seen in the May to June peak of 2020. Now, remember when we were discussing all this back then, there was fear of a drastic house price crash. The RBA was modeling a 40% crash. The newspapers were full of bank after bank predicting price corrections. And, well, what happened? Meanwhile, non-confirming arrears past 30 days overdue sat at 3.5% at June 2021. Borrowers have been able to build up repayment buffers, cure prior arrears positions, and stay on top of their repayments, S&P observed, with strong household balance sheets bolstered by government stimulus measures and low interest rates. Rising property prices have also enhanced refinancing options for borrowers by boosting equity positions in their homes. The Australian Bureau of Statistics data released on Thursday revealed that refinancing reached a height in July, with loan commitments rising 60% year-on-year to $17 billion. S&P reported refinancing has become a common way for borrowers to self-manage their way out of arrears. While some borrowers transitioned from the first round of deferrals to formal hardship programs in the second quarter, S&P said there had not been a noticeable effect on overall prime RMBs arrears performance, as low interest rates shielded most customers from entering into arrears. However, the lockdowns gripping New South Wales and Victoria are expected to crimp economic activity, with many businesses shuttered. Self-employed borrowers in affected sectors are more likely sensitive to cash flow pressures compared to full-time pay-as-you-go employees. They are tipped to be more strained, which will have a knock-on effect for specialist lenders. Driven by higher refinancing rates than prime borrowers, non-conforming prepayment rates hit a high, rising to 31.2% in the second quarter, comparing to 25.2% in quarter one. Non-conforming prepayments had not climbed above 31% since September 2015. In contrast, prime prepayment rate sat at 21.6% in quarter two, slightly rising from 20% in quarter one. Many prime borrowers are expected to cut their spending and build up their savings during lockdown, which will allow them to stay on top of mortgage repayments despite a deterioration in conditions. However, refinancing for self-employed borrowers in non-conforming transactions is tipped to be more constrained in the coming months, given the Sydney and Melbourne lockdowns, which S&P stated may dampen prepayment rates. The lockdowns are also expected to raise job losses, with S&P forecasting an average 5.3% unemployment rate for 2021 before shifting to 4.8% in 2022. While current lockdowns will affect GDP growth and jobs in the third quarter, we expect these effects to be temporary, the report noted. We forecast economic and employment conditions will begin recovering once restrictions are removed. This is written by Sarah Simpkins for Mortgage Business. So there you go, everyone. Arrears unchanged. Are you surprised? With all of the interventions that the government has done to keep the housing market going. What's the solution? What is the takeaway to all of this, everyone? Well, let's jump on the soapbox. Now, you're going to have people that are frustrated. You'll have people who are hoping that we'll start to see a flood of arrears once the bank's foreclosure promises disappear, and they will start to hope that people will be forced to sell and put their properties on the market. I can't see a big flood of them. And if there are any, I would imagine that the banks would manage that process to not, damage the value of their assets. We've already seen how much our government's willing to intervene in the market. I can't see it's at all surprising. Now, if you're in this situation when you're in arrears, I strongly suggest you reach out, get help, and get your finances sorted. Sort out your debts, sort out your issues, but there really aren't many people there. The biggest concern for many would be a sharp rise in the cash rate, driving up interest rates. Can you see that happening? Not for the foreseeable future, not for at least the next few years, unless something drastic occurs. As always, thank you all for watching, everyone. Please like, share, and subscribe to the channel. Let me know your thoughts and opinions on this one in the comments down below. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. Sign up for SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. I'll see you next time.